This is Accounting 200, Chapter 8 video. We're looking at receivables today. So these are the learning objectives. Describe the common classes of receivables. Describe the accounting for uncollectible receivables. Describe the direct write-off method of accounting for uncollectible receivables. Describe the allowance method of accounting for uncollectible receivables. Compare the direct write-off and allowance methods of accounting for uncollectible accounts. And describe the accounting for notes receivable. Next, describe the reporting of receivables on the balance sheet. Describe and illustrate the use of accounts receivable turnover and number of days sales and receivables to evaluate a company's efficiency in collecting its receivables. The receivables that result from sales on account are normally accounts received or notes receivable. The term receivables includes all money claims against other entities, including people, companies, and other organizations. Notes and accounts receivable that result from sales transactions are sometimes called trade receivables. Accounts receivables, the most common transaction creating a receivable is selling merchandise or services on account, which is on credit. The receivable is recorded as a debit to accounts receivable. Don't forget, we're creating the account receivable. We kind of looked at this before, but now we're getting into more depth. Such accounts receivable are normally collected within a short period, such as 30 or 60 days. They are classified on the balance sheet as a current asset because, don't forget, current assets are anything that is less than an accounting period, which is a fiscal year, so less than a year. Notes receivable are amounts that customers owe for which a formal written instrument of credit has been issued. If notes receivable are expected to be collected within a year, they are classified on the balance sheet as a current asset. Notes are often used for credit periods of more than 60 days. Notes may also be used to settle a customer's accounts receivable. What that means is once it moves away from account receivable, it goes into notes receivable because it's more than 60 days because it moves to a note. And then in this chapter, we'll take a look at how that happens as well. Other receivables, interest, tax, receivable from officers or employees. Other receivables are normally reported separately on the balance sheet. If they are expected to be collected within 1 year, they are classified as current assets. If collection is expected beyond 1 year, these receivables are classified as non-current assets and reported under the caption investments. Uncollectible receivables are a major issue of selling merchandise or services on account. Is that some customers will not pay their accounts. That is, some accounts receivable will be uncollectible. Companies may shift the risk of uncollectible receivables to other companies by not accepting sales on account and only accepting cash or credit cards. Companies may also sell their receivables. Selling receivables is called factoring the receivables. The buyer of the receivable is called a factor. An advantage of factoring is that the company selling its receivables immediately receives cash for operating and other needs. Regardless of how careful a company is in granting credit, some credit sales are uncollectible. The operating expense recorded from uncollectible receivable is called bad debt expense, uncollectible account expense, or doubtful account expense. So those are three ways to look at it. Some indications that an account may be uncollectible include the following. The receivable is past due, the customer does not respond to the company's attempt to collect, the customer files for bankruptcy, the customer closes its business, or the company cannot locate the customer. The two methods of accounting for uncollectible receivables are as follows. The direct write-off method records bad debt expense only when an account is determined to be worthless. The direct write-off method is often used by small companies and companies with few receivables. The allowance method records bad debt expense by estimating uncollectible accounts at the end of the accounting period. GAAP, generally accepted accounting principles, require companies with a large amount of receivables to use the allowance method. So just keep in mind, if you have a lot of receivables, you have to go with the GAAP allowance method. So the direct write-off method for uncollectible accounts, So assume 4,200 account receivable from DL Ross has been determined to be uncollectible. Here's how we recorded it. Bad debt expense. Don't forget that bad debt expense is going to the income statement, and then account receivable be DL Ross. Don't forget we're pulling out this off of DL Ross's. That's why it says 4,200 as a credit. An account receivable that has been written off may be collected later. In such cases, the account is reinstated by an entry that reverses the write-off entry. The cash received in payment is then recorded as a receipt on account. So here's the direct write-off method. So here's what happened. We reinstated it. So we put this back on as cash for 4,200, and notice how that flipped. So we put it as 4,200 to take it out, okay? Because we pulled it off a bad debt expense as well. Bad debt expense. Okay, so this is another example. Account receivable will be uncollectible. The following entries made: 30,000 for bad debt expense, and this goes for allowance for doubtful accounts for 30, and this is uncollectible accounts estimate. So we're estimating that we're not going to receive $30,000, so we're creating that allowance for doubtful accounts. So this one says doesn't know which customer accounts will be uncollectible. Specific customer accounts cannot be decreased or credited. Instead, a contra asset account allowance for doubtful accounts is credited for the estimated bad debt expense. It's usually a percentage of total account. So I think we'll get into that a little bit more in this lecture. The preceding adjusting entries affect the income statement and the balance sheet. On the income statement, the 30,000 of bad debt expense will be matched against the related revenues of the period. On the balance sheet, the value of the receivable is reduced to the amount that is expected to be collected or realized. This amount, 70,000, is 170,000 was done by 200 minus 30,000 is called the net realizable value of the receivable. So yeah, so that's kind of an example of how that might be calculated. When a customer's account is identified as uncollectible, it is written off against the allowance account. This requires the company to remove the specific account receivable and an equal amount from the allowance account. So here's an example. So 6,000 with X-Tone Company is written off as follows: allowance for doubtful accounts. Don't forget, this is the contra asset. Now we're pulling this off of that contra asset, and then we're making the adjustment on the credit side, and this is coming from John Parker's account receivable. So this is, instead of going to each individual account, this one goes to a doubtful account, which is on the other side, which is the other end to what we looked at before. So because allowances for doubtful accounts is based on an estimate, it will normally have a balance at the end of a period. As a result, the total write-offs to the allowance account during the period will rarely equal the balance of the account at the beginning of the period. The allowance account will have a credit balance at the end of the period. Oh, sorry about that. If the write-offs during the period are less than the beginning balance. The allowance account will have a debit balance at the end of the period if the write-offs during the period exceeded the beginning balance. So the allowance method, here's an example of what this looks like. What we're doing is we're taking an adjusting entry. Adjusting entry fills the bucket, allowance for doubtful accounts, and then writing off accounts empties the bucket, allowance for doubtful accounts, so we're emptying it. So that's a really good example of what this looks like as far as if you learn visually. I know a lot of times whenever I see a bunch of writing, I don't get it, but this one is a really good example of the allowance method. So write-offs to the allowance account. So here's allowance for doubtful accounts, so 6,000 and 3,900. So the balance at the beginning of the year was 30,000. So then we have to make so total accounts written off in year was 26,750. So we have an unadjusted balance of 3,250. Okay, so that's our beginning balance minus our write-offs. So here's so unadjusted balance. So this is the 30,000 minus the 32,100. This is if we go over. So if we go over now, we're going to have a debit balance of $2,100. So this is what it was talking about previously, if there's an overage or a shortage. So the allowance account balance credited, I just actually talked about this. Just the over and shortage after the end of period, adjusting entries recorded, allowance for doubtful accounts should always have a credit balance. So we'd have to make that adjustment. An account receivable has been written off against the allowance account may be collected later. Like the direct write-off method, the account is reinstated by an entry that reverses the write-off entry. The cash received in payment is then recorded as a receipt on account. So here's an example. Account receivable Nancy Smith, allowance for doubtful accounts. So that's going to go that goes into that big bucket. And then we're going to reverse it. So we're going to receive cash, and then account receivable, Nancy Smith. Okay, so that's the adjustment. So here's the reversal. Here's the actual receiving of the accounts. Because before, this would be allowance for doubtful accounts, and we would have pulled it out. Now we're putting it back into Nancy Smith's account and then paying it, or she's paying it. Estimating uncollectibles. The allowance method requires an estimate of uncollectible accounts at the end of the period. This estimate is normally based on past experience, industry averages, and forecasts of the future. The two methods used to estimate uncollectible accounts are as follows: percent of sales method and analysis of receivables method. So those are two important things to take into account and ways of creating that allowance for doubtful accounts. Percent of sale method, since account receivable are created by credit sales, uncollectible accounts can be estimated as a percent of credit sales. So here we go, balance of accounts receivable, $240,000. Balance of allowance for doubtful accounts is $3,250 credit, which will be on the right side. Total sales will be $3 million, so 0.75%. So bad debt expense $2,250 is estimated as follows: 3 million times 0.75%, so you get 22,500. Okay, so here's how we would create it. This is the journal entry. What we're doing is we're putting these funds into bad debt expense. Okay, we're creating these accounts, we're expensing it to the income statement, and then allowance for doubtful accounts. Remember, that's a contra asset on the balance sheet. So 22,500 as such. So percent of sales method, so our adjusting entry is 22.5, December 31. So we have a 30,000 balance. Here's how much was spent. So adjusted balance will be 25,750. Okay. All right. So the amount of the adjusting entry is the amount estimated for bad debt expense. This estimate is credited to whatever an unadjusted balance is for allowance for doubtful accounts. At the end of the current year, ARS Industries has the following: a balance, $800,000 debit. So that's the receivable. And then allowance for doubtful accounts credit, $7,500. Don't forget, that's a contra asset. That's why it says a debit and a credit. Okay, so keep that in mind. Okay, so the company recorded 3.5 million of credit sales. The company used percent of sales method, estimates half of 1% of credit sales for the year end. So these are the elements we need to look at. So here's what it looks like. So 0.5% of 3.5 million will be 17.5. So we create the bad debt expense, allowance for doubtful accounts. So that will go in there as an adjusting entry. So our 7,500 balance, we add 1,750, so our adjusted balance will be 25,000. So here's what it looks like. Our account receivable is 800,000. Our allowance for doubtful accounts is 25,000. So that's the contra asset. So the net realizable value, that's the account receivable minus the allowance for doubtful accounts. So it's 77,500 or $775,000. 775,000. The analysis of receivable method is based on the assumption the longer an account receivable is outstanding, the less likely it will be collected. So here's what it looks like. Step 1, the due date of each account receivable is determined. The number of days each account is past due is determined. This is the number of days between the due date and the account and the date of analysis. Each account is placed in an age class according to its days past due. So it'll be 0 to 30, 31 to 60, 61 to 90, and then usually they say 90 to 120. At least at NAPI they do 91 to 120, and then anything after that they go into notes receivable. And then 4, the total for each age class is determined. Step 5, the total for each age class is multiplied by an estimated percentage of uncollectible accounts for that class. And 6, the estimated total of uncollectible accounts is determined as the sum of the uncollectible accounts for each age class. The preceding steps are then summarized in an aging schedule, and this overall process is called aging the receivables. Okay, so here's an example. This is a schedule of this. Notice how past due, nothing for 1 through 30, 1500 for 31 through 60, nothing through 6190, 91 to 180 is 3500, and then 81 to 365, $2,600. So notice there's a percentage: 2%, 5%, 10%, 20%, 30%, 50%. So those percentages are an estimate of how much we'll collect. Okay. So I'll stop right here since it is about 15 minutes, and I'll record the following video later on and post it.